I would say it's definitely better to name your estate than not name any beneficiary, because your estate is probably a much smoother settlement process. It might have to go through probate, but it would be more clearly labeled as to what you want to have happen with this money. If there is no beneficiary labeled, then it could make the probate process a little more complicated and slow down this money getting dispersed.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This week, I'm tackling another listener question, and Mark writes in, and he has an HSA account, but he's not sure what would happen to his HSA account when he dies. So in this episode, I'm going to talk about what happens to your HSA account when you die and the different beneficiary options that you have. And if you've listened to my past episodes on HSA, or as they're fully known, health savings accounts, and good for you, you're probably well ahead of the game. But if you're a new listener and you haven't listened to these episodes, then I definitely suggest you go back and listen to episode 1 and episode 44, where I get into more of the specifics about an HSA or health savings account. But just to save you a little research, the reason why I'm such a big fan of health savings accounts is that they are known as the only triple tax-free investment account that's out there. And what that means is that you're eligible to receive a deduction when you contribute to the account. You can invest the money and have it grow tax deferred. And when you take the money out, as long as you use it for health-related expenses, it is also tax-free. So there's no other account like that out there. Every other account, whether it be a 401k, where you get a deduction when the money goes in and you pay tax when the money comes out, or a Roth IRA, where you do get tax-free distributions, but when you put the money in, you have to pay tax on it. And that's why I'm such a fan of health savings accounts. So as far as what happens to your HSA account when you die, well, it really depends upon how you have the account set up. And ultimately, the goal for setting up a health savings account would be that you contribute to the account, you leave the money invested, or you definitely invest the money, and you leave it in there for a while. And then when you get into the retirement years, you either use the money for health-related costs and don't pay any taxes, but if you end up having a large health savings account and you have more in there than you could use, you can also take the money out and you could use it for non-health-related costs. And in that case, you would just pay taxes on the distributions, but there would be no penalty. Whereas if you do take a distribution for non-health-related costs before 65, you'd owe taxes and a 20% penalty. So you have, as I mentioned, a few options about setting up your beneficiary. And who can you name as a beneficiary? Well, if you're married, you probably want to make your spouse the primary beneficiary. This would then allow your spouse, when they inherit your HSA account, to leave the account in their name, and they could then take out distributions in the same manner that you could, where they can take it out to pay for health-related costs and not pay any taxes or penalties. Or if they're over 65 and they want to take it out and use it for non-health related costs, they would just pay taxes. Another thing, if you do name your spouse as the primary beneficiary, and let's just say you each had your separate health plans and you had a high deductible health plan, but they did not have a high deductible health plan, then they could actually keep your HSA account and continue to be on their low deductible health plan that maybe didn't qualify them to make HSA contributions, but that doesn't disqualify them from keeping your HSA account and then being able to use it on either those health-related costs or non-health-related costs. Next, you could name a non-spouse beneficiary, and this would be a child, a grandchild, a friend, a cousin, anyone who's not a spouse. Unfortunately, with this setup, the HSA account ends on the date of your death, and any funds that are remaining in that account are distributed and are taxed at the fair market value of the account on your date of death. The beneficiary can then use the funds to pay for any qualified medical expenses that you had up to 12 months after your death, and they will not be taxed on that amount. So they have a little bit of flexibility with paying those medical expenses that might have not been settled before you pass away, then if the money was invested, the account can make gains between when you pass away and when they actually inherit the account, when they're able to get it into their name. And if there are any capital gains between your passing and when the account is transferred to them, those would be taxable just like any other capital gain tax would apply. Your next option would be using some type of trust, either an irrevocable trust or a revocable trust as the non-spouse beneficiary. And very similar to the previous option of naming a non-spousal beneficiary, this type of beneficiary, the trust beneficiary, the HSA would also end on the date of your death. And the fair market value of the account would be included on your final tax return. This does allow you to pass the money to beneficiaries through any trust planning that you might do, which there are other reasons to do this, such as giving them creditor protection, upon your passing, or if you want to have restrictions on the way that they can spend your money upon your passing, then these are the reasons to have the trust as the beneficiary. Unfortunately, there's really no tax benefit to doing this because it is still taxable, just like it would be if you named them directly through the beneficiary form. The additional benefit that you're getting is any of that trust planning or additional restrictions that you want to have there. And especially if you have minor children who would be your beneficiary, this minor children cannot actually inherit money. So this is a reason why you might want to have a trust as the beneficiary of your health savings account if you do have minor children rather than directly. And your fourth and last option would be to either not ever name a beneficiary or to name your estate. And like the last two examples, the health savings account would also end on your death, and the fair market value would be included in your final income tax return, and the HSA would be then distributed to your estate. I would say it's definitely better to name your estate than not name any beneficiary, because your estate is probably a much smoother settlement process. It might have to go through probate, but it would be more clearly labeled as to what you want to have happen with this money. If there is no beneficiary labeled, then it could make the probate process a little more complicated and slow down this money getting dispersed. So what should you do next? Well, you definitely should review your current health savings account to find out if you have a beneficiary on file. And if you're married, you want to probably strongly consider making your spouse the primary beneficiary, because that's the best option. That would then allow your spouse to be able to then utilize this account over their lifetime. And if you don't have a spouse, then you want to just have it set up probably according to what your wishes are, whether that have it be going to your children or just having it go to your children through your estate. You can also name your estate on there as well. It really just depends on how easy you want to make the process for your children. Making them the direct beneficiary rather than the estate will make it a smoother process. From dealing with past estates for clients, it could take months, even years for an estate to be settled, and they might be waiting on getting that money until that happens. So rather than having to wait that long, you should probably just name them directly. And if there is no one that you want to get the money, you want it just to go to a charity, then you could also name them in your health savings account beneficiary designation, or you could just set it up through your estate. So if you haven't taken care of this, make sure that you log into your HSA account or reach out to your HSA provider and get this set up. And Mark, I appreciate the listener question. I hope this has been helpful to you. If anyone else listening has a listener question, you can ask for your listener question to be addressed in a future episode by going to retirewithryan.com. From there, click on the contact button, enter your name and question, and I'll consider that for a future episode. Have a great week, and I look forward to talking to you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.